Hi, in this example, I want to help you understand how to calculate the depreciation expense using the straight line method. There are three methods. We're going to go through each one of them one at a time, starting with straight line method. What are fixed assets? Fixed assets are long-term assets. They are permanent assets and they can be classified as equipment, machinery, buildings, and land. Other description for fixed assets are property, plant, and equipment. They exist physically and are tangible assets. And they are owned and used by the company in its normal operations. They are not offered for sale as part of the normal operations of the business. They're used internally. Now, fixed assets like building, equipment, machinery, they over time lose the usefulness of them. They deteriorate. The effectiveness of the use diminishes over time. In accounting, you have to account or record the cost that comes from the loss of the usefulness of these assets, and that is called depreciation. Depreciation expense. That's how you call or account the cost of the loss of usefulness or the diminishing effectiveness of the use of the assets. There are three things you need to know before calculating the depreciation expense, and these are cost, which is what the company pays for the assets, plus any incidental costs such as sales taxes, freight, installation, testing for use, permits, and so forth. Those are part of the cost. In this example, we're going to assume that this cost is the final cost. Estimated useful life is the lifetime that this asset is going to be used for. It's like the longevity of the asset, such as one example of those is what happens with insurance companies. They determine how long a person is going to live. They have a calculation, they have a number that lets them know what the longevity of a person is based on certain factors like the health, genetics, and so forth. The same with the fixed assets. Residual value is the value of the asset at the end of its life. Basically, just when you cannot get any more out of it. Think about it as the lemon. I like to think of it as when you squeeze a lemon, and as you squeeze the lemon, you get as much as juice out of it as possible. And you squeeze it until you cannot get any more out of it. That's the same with the residual value of an asset. When it cannot go forward, move forward anymore. So that's why it's called scrap value. Residual value. Another name for residual value is salvage value or scrap value. Scrap right here. Scrap or salvage value. We're going to calculate this depreciation by utilizing this example. This fictitious company, Agape company, purchased and equipment at a cost of $84,000. Management estimates that the useful life of this asset will be 5 years, and the residual value will be $10,000. The next step in calculating the depreciation under the straight line method is to determine the depreciable cost, which is what is the actual cost we're going to use to calculate the depreciation expense for every year. The cost is $84,000, like we said before, minus the residual value gives us the depreciable cost. That is the cost we're going to be using for every year. Now, as we said before, the estimated lifetime is 5 years. Now we're going to express the 5 years in terms of a percentage. 100% divided into 5 is 20%. If the useful life was 3 years, 4 years, you would divide 100% into 3. If the estimated lifetime was 4 years, you would divide 100% into 4. All right. So as we said before, the depreciable cost is $74,000. 74,000 multiplied by 20% gives us the first year depreciation expense. Now, the accumulated depreciation is the same for the first year, would be the same as the depreciation expense. Accumulated depreciation is a contra asset account, is a permanent account, is a balance sheet account. That's why it's a permanent account, and is considered a contra asset account, which means that it's a credit balance account but not a liability. It's contra asset. It goes against the asset, if you want to put it that way. Now, the first year depreciation expense, like I said before, gives us the first year accumulated depreciation will be the same for the first year. The book value, however, is the cost of the asset minus the accumulated depreciation. For the first year, we have the book value minus accumulated depreciation is $69,200. Book value is the value of this asset in the books, meaning in the accounting records, right? Let's not confuse that with any other terminology. Book value is the value of the asset in the accounting records. You'll see this number in the balance sheet because you'll have the cost. In the balance sheet, you present the cost minus the accumulated depreciation. And then we'll see the book value reflected in the financial report called balance sheet. Now, the second year depreciation is $74,000. Again, cost is the same, right? Depreciable cost multiplied by 20%. Now, remember I told you this is straight line method. The straight line method is, as the name implies, straight. Straight is a line that goes straight and never bends. It's constant. It remains unchanged. So the depreciation for every year, depreciation expense will be the same. However, the accumulated depreciation, like I said before, it accumulates. To determine the accumulated depreciation, you add the depreciation expense for the second year plus the accumulated depreciation for the first year. And that gives us $29,600. Book value is, as I said before, the cost, $84,000, minus accumulated depreciation, $54,400. As the accumulated depreciation increases, the book value will decrease. Now, the depreciation expense for the third year, as I said before, is multiplied by 20%. The depreciation expense will be the same. The accumulated depreciation is the accumulated depreciation of the second year plus the depreciation expense for the third year. $39,600 will be the book value. $84,000 minus accumulated depreciation of $44,400. Fourth year follows the same pattern, and we get an accumulated depreciation for the fourth year of $59,200, which is the result of adding the sum of accumulated depreciation for the third year plus depreciation expense for the fourth year. Now the book value is $24,800. At the end of the fifth year, remember this asset is estimated to last for 5 years only. Our accumulated depreciation is the same as the depreciable cost at the end of its lifetime. It means it has fully depreciated. It cannot depreciate it more than that. It has reached the depreciable cost. And the book value, which is the result of subtracting the accumulated depreciation for the 5th year minus the cost is $10,000. The accumulated, the book value now equals the residual value. One thing that I want to mention is if you need to know how much is the accumulated depreciation, you're asked to calculate the accumulated depreciation for the 2nd year. And you don't have this table, or you don't have, under the straight line depreciation, you wouldn't have to do this table anyway, because it's the same every year. So if you need to determine, let's say, a partial year depreciation, partial year depreciation is the depreciation that you would have to calculate in the middle of the year. For instance, let's say you're asked to calculate the depreciation expense for after 2.5 years of use, right? So how do you calculate that? Well, simply, you just have to find out how much is the depreciation for 1 year, which is 14,800. But let's assume we don't have this table. So you multiply, you divide 74,000 into 5 years of use. That gives you the annual depreciation. And we don't have to put this sign in here. Annual depreciation of 14,800. And then you multiply that annual depreciation by 2.5. 2.45. That would give us the accumulated depreciation after 2.5 years. What about, or what if you would be asked to calculate the depreciation for 8 months only? Same concept. You already have the depreciation expense for 1 year, so you take 14,100, and you only want to know how much is for 8 months. So 14,800, break it down into 12 to find out how much is the depreciation expense for each month of the year. So the depreciation expense would be 12,033 for 8 months, right? Multiplied by 8 months would be 9,866 and 67. And this is the partial depreciation. All right, so I hope this was helpful to you, and will going forward will enlighten your understanding on how to calculate the depreciation expense by using the straight line method. Thank you.